Hello dear fellow valuers. So today we are going to start our fourth session on market approach to valuation. In today's session we are going to discuss concepts, examples and case studies on hypothetical plotting scheme for valuation of large sized land, hypothetical building method, belting method for land valuation, recessed land concept and landlocked method. So these five methods, concepts we will discuss and examples and case studies as well. This is the full syllabus as per IBBI syllabus, and it carries 7 marks already discussed in first session of current series, and numericals up to 20 marks can come from this chapter. So hypothetical plotting scheme for value of large size plot. So hypothetical layout methods or plotting methods are basically to estimate fair market value of large area land pieces on the basis of sample sales data of small plots. So because in case of large plots many transactions do not happen, so we may get data for small plots. So with the help of that data of sale data of small plots, we can calculate value of a fair market value of a large plot. These are the methodologies through which we can calculate, where recent sale data of similar large size plot is not available. The small plot can be fully developed, partially developed or open plot. So these three categories are there. So first method is a hypothetical plotting scheme, and steps involved in this first method are, first, as a valuer we have to prepare best possible layout of the plots for which sale data is available. On the large piece of land, the layout should have mention of size of plot and area of road and common space, etc. So as per local bylaws guidelines, we have to bifurcate, we have to prepare a tentative layout of the plotting scheme on that large piece of land, and plot size should be in line with the sales data we have. So if we have a sales data of say 10 by 10 plot or 10 by 10 meter plot, then we should do plotting as per the sale data. Then after the second step is that after comparing various parameters like size, location, access frontage on main road, etc., market value of the plot to be calculated. So second step is that we have to calculate market value, because within that scheme some plots may be front side, some plots may be rear side, some plots may be corner plots. So they may be having different values. So we have to we have to do grouping of those plots into various sets of almost equivalent value. Then third step is that based on sales velocity in nearby area, estimate time required to sell the plots, the gross realization sale proceed of all plots to be deferred by the average period of selling plots. Average period means half of the total period, and at that and at an appropriate ROI, rate of return on capitalization rate, considering use and risk involved in the sale of residential or commercial plots. So we have to estimate how much time, what is the number of plots which we are going to design in the layout of the large piece of land, and how much time, estimated time, it would take to sell all those plots. So if say depending on past transactions, say there are 100 plots which we are going to have and that large land piece of land, and on an average monthly basis 5 plots used to get sold. So 20 months would time would take. So average we can say 10 months time will take to sell all the plots. The next step is that estimate cost of financing the project. Cost of financing means interest on capital invested or capital borrowed from the bank. The next step is that estimate developer's profit. So whatever profit developer is expecting out of the project, and this developer profit is calculated as percentage on gross realization amount of sale of plots. So please note this point. The developer profit is always calculated on the gross receipt of all plots. So percentage developer profit, the percentage developer profit has inverse relationship with gross realization of plots and direct relationship with estimated time to complete the project. So these are the two things which we should remember. One mark question can come. Then estimate time, cost of development, cost of providing infrastructure, and cost of common space, etc. So other costs involved in the project. So normally development takes 1 to 2 years time. Take one or 2 years ahead of sale of the plot. So thus, if plot are estimated to be sold in 6 years, then development should be completed in 4 to 5 years. So development means sewage, road, street lights. So whatever development we have to do, infrastructure development in the society, in the colony, in the layout, that is required to be done, and the cost involved in that, and normally it is required to be done before completion of the project, at least 1 or 2 years completion of the project. So next step is that estimate other development cost like consultant fee, legal fees. So previous cost which we discussed, those costs were like with passage of time the developer has to spend. But all these costs like initial expenses, consultant fee, legal fee, authority stamp fee, stamp duty, etc. So there are some initial expenses, initial fee or other development fees which is also required to be paid. If at all these costs are not required to be paid in initial phase, so we should make a note of it, and accordingly we have to do discounting to find out present value of these values which are required to be incurred in future. Then after that we have to calculate market value of the land, which is equal to gross receipt from sale of all the plots. So number one, we will calculate gross receipt from sale of all the plots. Then we have to deduct sum of all cost, whatever cost of construction, cost of street light, road, infrastructure, whatever cost, other development costs. So all costs we have to deduct. Then developer's profit, which is a certain percentage on the gross receipt from the project of the plots, and we have also required to deduct interest cost from the gross receipt to arrive at the market value. So that gives the market value. So since this method gives residual value of large size plot, this method is also called residual method. So let us try to understand all these steps with the help of an example. Calculate market value of a large piece of commercial land of size 86 by 192. The study of sale in nearby area indicate that land rate at the rate of 5 lakh rupees per shop to 8 lakh rupees per shop. Other assumptions are as enter. So we have a large piece of land, and which is piece of land size of the large piece of land is 86 by 190 feet. And as per market study, as per sales data collected from the local market in the nearby area, so per shop rate ranges from 5 lakh rupees per shop to 8 lakh rupees per shop. So all plots are likely to be sold in 4 years. So this is the sales velocity based on data collected from the market. Expected yield, ROI, capitalization rate, IC, R. So expected yield from the project is the 9%. Development cost like CLU, change of land use, NOCs, etc. Are required to be incurred is rupees 5 lakh rupees initial expenses. Then minimum 20 feet road is required as per local bylaws. So as per local bylaws, minimum 24 square feet road is required. Loan of 1 crore rupees at the rate of 10% is taken for development, and builder profit is 10% of the gross sale price of the plot. So as discussed in the various steps, so first we have to prepare a layout. So say we prepare this layout. So this is the layout. This side 86 and this side 130. Right. So 130 is there. So let us assume that since these 6 shops are there in front, so obviously these shops will be having more value because there is one more road. These are front shops, and are having prime location. So these 6 shops say are having highest rate of the shop, that is 8 lakh rupees per shop. So 1 2 3 4 5 6. So total market value of these 6 shops is 48 lakh rupees. Right. After that, these 7 to 13 front shops, 1 7 8 9 10 11 12 13. Let us say these 7 shops this side and 7 shops inside in front of these shops. So put together 14 shops are in the middle of the layout. So these shops they say have value of 6 lakh rupees per shop. So 14 into 6, it gives value of these 14 shops equal to 84 lakh rupees. And these backside 4 shops, backside 8 shops which are having at rear location. So because of that backside location, let us assume lowest valuation of these 4 this side and 4 opposite shops. These 8 shops are having value equal to 5 lakh rupees per shop. So put together value of 8 shops will be equal to 40 lakh rupees. So here we can calculate total gross receipt, likely gross receipt from the project by dividing that large piece of land into 28 shops is equal to 172 lakh rupees. If sale of all plot is likely to take place in 4 years time, then value shall be deferred by 9% yield for average period of 2 years. So because these shops will be sold in period of 4 years, so this concept we have to understand. So say 28 shops are there, so every year we are going to sell seven shops. So almost every 2 months we are going to sell one shop. So it is a continuous process. So we will receive say one shop will be sold in first 2 months, then next shop will be sold in third and fourth month. So we will get a regular cash flow. So accordingly, let us assume it will take 4 times. So average time period is 2 years, within which we can assume that average period of receiving the receipt is 2 years. So interest cost is 1 lakh rupees, 10%, so 2 years. So since we are going to receive these receipts within 2 years, so we have to calculate interest for 2 years, because from that sale receipt we are going to serve our interest. So for same average period of the project, we have to calculate interest. This rate of interest is given and loan amount is given. So 20 lakh rupees of interest has to be paid. Then builder profit is given 10% of the 10%. So 10% of the gross receipt of the project. This is equal to gross receipt we have calculated here. So 10% of it is equal to 17.20 lakh. Since interest cost and builder profit will be linked to sale of plots, so once the plot will be sold, then we will be able to parallelly we will be required to serve interest, and builder will take out his profit. The sale proceed of 135 lakh, that is 172 is a gross receipt minus 20 lakh rupees of interest and 17 lakh rupees of 17.2 lakh rupees of builder's profit. So will get deferred by average period of 2 years. So these interest cost, gross receipt we will get during period of 4 years and average period of 2 years. Interest we are supposed to pay during period of 4 years and average period of 2 years, and likewise gross profit, builder's profit will also be deferred for next 4 years, and we can assume average period of 2 years. So accordingly, present value of net sale proceed, which is the sale proceed net of interest and builder profit, is equal to 135 divided by 1.09 raised to power 2. So it is capitalization method which we had discussed in previous slide. So present value of these 135 lakh rupees of gross receipt is to be 113.63 lakhs. Then we have to deduct initial expenses of 5 lakh rupees from present value of net sale proceed to calculate net realizable value of the plot which developer can offer. So since developer is required to pay 5 lakh rupees upfront for getting CLU, NOCs and other development charges, initial expenses. So out of 113.63 lakh rupees, this we have to deduct 5 lakh rupees out of it, and the remaining this is the maximum land amount which developer can offer to the owner, and this is the fair market value of the land. So next method is hypothetical building method. So these methods are also used for valuation of large open lands in two circumstances. So in previous case we did valuation of large open land. Here also we are doing large open land, but in previous case we were having sales data of the small open plots. But in this case, if we don't have availability of that data, then in case sale data pertaining to comparable size plot and even smaller plot is not available, however data pertaining to sale instance of built up units in nearby area is available. So if we do not get data pertaining to the open plots, however, because in some urban areas sales data may not be available, so in that case we may get data pertaining to the developed units, houses or flats. So in that case, we can use this method. This is scenario number 1, and scenario number 2 could be possible in case sales data pertaining to comparable size plot and even smaller plot is not available. However, developer intend to let out the flat, shop, offices, etc. on rent instead of selling the flats. So if the developer, having data pertaining to income, data about income of those flats, even if data pertaining to sales data of built up units is not available, but their income data from those built up units are available. So in that case, hypothetical building method can be used. So let us try to understand various steps in these two scenarios with the help of example. A developer desires to purchase a property by entering in an agreement to sell together with irrevocable power of attorney to get the plans duly approved and enter into agreement to sell flats, etc. Other details of the project are as under. Area of plot is 1800 square meter. It is an old tenanted building of ground floor exists in the plot and has existing built up area of 500 square meter. Total rent from the building is rupees 2500 rupees per month. FSI of the zone is 1. Replacement cost of the building is 8500 rupees per square meter. Present sale price of flat in the locality is 50,000 rupees per square meter. Expected developer's profit is 15% on sale revenue. Interest on borrowed capital is 12% on 50% of the sale value for 1.5-year period. Assume settlement period for tenant and complete development at 2 years and legal cost at 1 lakh rupees. Scrap value is 600 rupees per square meter. Advise fair price of land purchased to be offered to vendor. It is assumed that the builder will get plans duly approved and start selling the flats on the basis of approved plan without waiting for tenant being evicted. So here we have to calculate fair market value of the underlying land, and all these facts and information has been given in the question. So this is scenario number 1. Step number 1 is that total, first of all we have to calculate net sellable area. Total built up area under hypothetical scheme is 1800 square meter, and tenants rehousing will take 500 square meter because land area is 1800 square meter. FAR allowed in this scheme is 1. So maximum built up area which can be constructed in this scheme is 1800 square meter. Already 500 square meter of built up area is there. So that built up area is required to be given to the existing tenants. So net sellable area which will be available to the builder will be 1300 square meter. So this is the area which builder can sell to receive the gross receipts. In step number 2, since present sale price of the flat is 50,000 rupees per square meter, so thus net realizable value, sale value, by builder can get amount of 650 lakh rupees by selling this 1300 square meter. So net sellable area is equal to 1300 square meter. Net sale price has been given in the question, 50,000 rupees per square meter. So 1300 into 50,000, that gives us the value of net realizable sale value or gross receipt from the project for the builder. Third step is, since developer shall start selling flats immediately after getting plan approval, and there is tenant settlement period of 2 years and development period of 2-year period, since builder has borrowed 15% of sale value for 1.5 years. A minimum return which the builder would expect is 12%. Thus capitalizing sale proceed for 1 year, which is half of the capitalization period of 2 years. In this case, present value of net realizable sale value is equal to this. Because this 650 lakh rupees of amount the builder will get not in a single shot. Instead, the builder will get that will be able to sell these flats in small pieces during the course of time. So some amount will be received in first month, second month, third month, fourth month, and so on. He will receive last amount in 24 months. So average collection period of these 650 lakh rupees is say 1 year. So since builder is going to pay 12% interest on the loan amount for 1.5 on the loan amount, so and this should be the minimum expected return, because I have to pay 12% to the bank. So as a builder I should expect at least 12% of return on my capital also. So present value of these 650 rupees is discounted, is divided by 650 divided by 1.12, which is equal to 579.80. This is capitalization rate formula already discussed in previous slides. Then in next step we have to calculate present value of all the expenses. First we have to calculate all expenses which are required to be incurred to receive the gross receipt, and then we have to calculate present value of those gross receipts. So what are the total other expenses which builder is required to incur during next 2 years? Number one, building cost. So cost of construction of the building. So since 1800 square meter of built up area is required to be constructed, and cost of construction as given in the question is 8500 rupees per square meter. So 1800 into 8500 rupees. So this is the value of total value of cost of construction of the built up area, 153 lakh rupees. Then developer profit is given as 15% of the sale value in the question. So since sales value is 650 rupees as calculated in the previous slide, so 15% of 650 is 97.50. This is builder profit. Interest cost is 12% on 50% of sale value for 1.5 years. It is also given in the question. So 12% of this is 12%, 50% of gross receipt 650 by 2, and 1.5 year is the loan repayment period. So 58.50 lakh is the interest period, interest amount which builder has to pay to the bank. Then legal expense 1 lakh rupees lump sum he has to pay. Then total expenses are 153 plus 97.5, 58.5 plus 1, and total amount is 310 lakh rupees, which is required to be incurred during the period of next 2 years. So again, average period these expenses are required to be incurred during period of 2 years, spread over the period of 2 years. So average period of expenses say 1 year. So we will capitalize these 310 lakh rupees by 10%, by 12% rate of capitalization. So this gives us the value of present value of these 310 lakh rupees is equal to 276.52. So 276 is present value of 310 lakh rupees. Then in next step we will calculate net income in the project or from the project is equal to present value of net income as we have calculated in step 3. So present value of total income or total receipt from the project minus present value of total expenses as calculated here. So after calculating net income from the project, we have to calculate scrap value of the project because this data is also given in the question. So since scrap value which is given in the question is rupees 600 rupees per square meter, and area of existing structure by existing built up area of the project is 500 square meter. So builder will get additional scrap value of old structure before starting of the project. So this is also a cash inflow which builder will get at initial at commencement of the project. It is equal to 600 rupees per square meter, which is the scrap per square meter rate given in the question, and area of the old structure which is 500 square meter. So put together 600 into 500 is equal to 3 lakh rupees of initial amount builder will also receive. So total net income from the project will be net income as we have calculated in step number 5 plus scrap value. So builder will receive total 303.28 lakh rupees from the net gross receipt from the project plus 3 lakh rupees of scrap value. So total value of the project for the builder is 306.28 lakh rupees. Thus market value of land is equal to 306.2. This is the fair market value, and this is the maximum amount builder would like to pay to the landlord for the piece of land. And since land area is given in the question, which is 1800 square meter, that means land rate is equal to market value of land divided by land area, which is equal to 306.28 divided by 1800. That means 17,015 rupees per square meter is the answer to the question. So examiner may ask total value of the land. Examiner may also ask land area, land rate per square meter. So these two questions can come in IBBI exam. So scenario number 2 which we discussed in previous slide, let us understand the steps. So where builder tend to let out the property, if builder is planning to not to sell the property, instead he is planning to construct the property and give it on lease, then in that case we can do valuation using following steps. So step number 1, prepare suitable building scheme for the plot of land in conformity with the local building bylaws. So first we have to construct a building, building plan, building scheme like layout kind of thing. Then calculate present value of all project expenditures like cost of construction of building, road, sanitization, water supply, etc., along with interest cost, builder profit, legal expenses. Whatever expenses are required to be incurred at what time, so present value of those expenses is to be calculated. Step number 3, estimate area of building that can be let out and likely annual rent or and rental income from the building. So what amount of rentable area the builder is going to construct in the building, and what would be the likely rental income from that area. Step number 4, calculate value of property using rental method of income approach. This method we have discussed in previous series on income approach to valuation. You can refer that. So there are multiple techniques to calculate present value of the future rental. And step number 5 will be calculate present value of the market value of the project or the property as calculated in step number 4 for period of construction. So say the building is going to be constructed after 5 years. So after 5 years we will start getting rent. So whatever value we will get in step number 4, that value will be present value after 5 years. So we have to further discount it, capitalize that value from 5th year to 0 year. So direct capitalization method we have to utilize. So here we may be required to do perpetual yield purchase or sinking fund, something like that, but here we have to use direct capitalization method as discussed in previous sessions. So in the next step will be calculate present value of land, which is equal to present value of market value of property, right, as calculated in step number 5, minus present value of all expenditures. So then step number 4, add scrap value of the existing structure on the land, if any, to arrive at the total market value of the land. So more or less these steps are similar to the previous example which we have discussed. Now next method is belting method for land valuation. This is an important method, and 1 or 2 mark question can come out of it. The method is normally used in case of income fetching deep properties. So here I repeat, deep properties where sale data of comparable plot is not available. As we go away from the main road, value of land goes on decreasing. Thus this method is applicable in case of properties in one single ownership having greater depth, and should not be used for estimating values of properties in different ownership. So if a large piece of land is there whose front is normal as compared to market, but the properties are very deep, and the 2 conditions for using this method is that condition number 1, the large plot should be under ownership of a single person, and number 2 criteria or parameter for using this method is that the depth of the plot should be large, and should not be used for estimating value of property in different ownership. So if multiple ownerships are there, then this method should not be used. So as per this method, the plot is being divided into 3 horizontal belts for doing the valuation. Let us see. So this is the diagram which explains how to divide the large deep plots under single ownership. So as per Supreme Court decision ruling, following assumptions are to be made. These assumptions would not be given in the question, so you have to remember these assumptions for calculating this thing, or the examiner may tell you that calculate using belting method. So if it is written in the exam that belting method is to be used, so all these assumptions are required to be made at your end. You have to remember these assumptions. So for depth of the first belt, so this is the first belt. So this is the width, and this is the total depth of the plot. So this is very deep plot having relatively small front. So front belt will be equal to depth of the front first belt. This is the front belt. First belt is equal to average depth of properties fronting on the road. So we have to see what is the average depth of other adjoining or nearby plots on same road. So accordingly, say 30-40 meters. So accordingly we will also take similar depth for this plot number 1, and then land rate for first plot we will take as per sale data. So whatever data we capture from the market, because these size of comparable plot data, sale data might be available in the market, so that sale data we will get from the market, and accordingly we will take rate for the this front plot. Then second belt, this is the second belt. It is also called middle belt. So what will be the depth of this middle belt? Its depth will be equal to 1.5 times of depth of first belt. So if we are considering the depth of this belt as 50 meter, then it should be 75 meter. If it is at 30 meter, then it should be 45 meters. So 1.5 times of the depth of the first belt is equal to depth of the second belt, and rate will be obviously less because it is a rear plot. So as per Supreme Court decision, land rate for second belt will be equal to whatever rate we have considered for this front belt. Say if we have taken rate of 300 rupees for front belt, then rate for second belt will be 2 divided by 3 multiplied by 300, 2/3 of 300, which is equal to 200 rupees. So 2/3 of first belt rate will be equal to will be taken as land rate for second belt, and this is the third belt, rear belt or last belt. So what will be the depth of the last belt? It is equal to total land, total depth minus depth of the first belt minus depth of the second belt. So whatever total depth is there, we have to reduce depth of first and second belt, and remaining depth will be available for the third belt, which is called rear belt. And rate for this land rate to be considered for the third belt for valuation is equal to half of the rate of the first belt. So whatever rate we have considered for first belt, say if it is 100 rupees, then land rate for rear belt will be 50 rupees. Let us try to understand this belting method with the help of an example. A large plot having 150 meter of road frontage and 400 meter of depth is required to be valued for purchase. Work out the value of plot by belting method. Here belting method is given, so we have to make all assumptions whatever we have understood in the last slide. If nearby 30 meter deep plot are available at rate of 300 rupees per square feet. So here depth of nearby plot is given, land rate of nearby plot is given. It is mentioned that belting method is to be adopted, and dimension of the bigger plots are given, so we have to value the bigger plot. So data given is this: width of the bigger plot, depth of the bigger plot, depth of the nearby plot, and sale data for the nearby 30 meter deep plot, and the value of plot has to be calculated. So with the help of graph which we have understood in previous slides, so this is the table. First belt depth will be equal to x because similar data is given, that this data is given. So 30 meter deep, first belt will be of 30 meter deep, and that means land area, since front is 150, it is given in the question, so 150 meter into 30, so total area of the first belt will be 4500. Since valuation land rate for similar size plot as per data collected from the market is 300 rupees per square meter, so total value of the front belt is equal to 13,50,000 rupees. 4,500 into 300 rupees per square meter, which is equal to 13.50 lakh is the value of first belt. Likewise second belt depth we can calculate, it should be 1.5 times of the depth of the first belt, so it is equal to 1.5 into 30 meter, because 30 meter is the depth of first belt. That means 45 meter is the depth of the second belt, and that means area, front remains same 150, width remains same, so 150 meter is the width of the second belt, and 45 meter depth we have calculated here. So total area of middle belt or second belt is equal to 6750 square meter, and valuation rate, land rate to be considered should be 2/3 of land rate considered for the first belt. So first belt is 300 rupees, so second belt is 300, 2/3 of 200, which is equal to 200 rupees. So value of second belt is equal to 6,750 rupees 50 square meter into 200 rupees per square meter rate. So 13.50 lakh is the value of second belt. Likewise third belt, what will be depth? Depth will be equal to 400, which is total depth of the deep plot, minus depth of the first belt, and depth of the second belt. So the first belt is 30 meter deep, second belt is 45 meter deep, so put together 325 meter will be the depth of the third and last belt. So land area will be equal to, width is 150 for all the plots, so 150 into 325, so that means 48,750 will be the square meter will be the area of the third belt. And land rate to be considered for valuation should be 1/2, 50% of the land rate considered for the first belt. So that means since first belt rate was 300 rupees, so 50% of it for the rear belt is equal to 150 rupees per square meter. So 48,750 into 150 rupees per square meter is equal to 73.12 lakh is the valuation of third belt. So if we add value of all these three belts, that gives us a value of 100.12 lakh, which is the value of land of the this 400 meter deep depth. So if we are asked about the land rate, so land value we have calculated this, and land area we know we have been given in the question, which is 60,000 square meter, 150 into 400 meter. So that gives us a land area, land rate for the full plot of 166.87 as against 300 rupees per square meter land rate for a small size of nearby plot. So fourth step is recessed land concept. So this is an old method of valuing odd shaped plots or plots having an offset in the rear. What is offset? This is the amount of offset which is not abutting the road. So offset or portion of land not abutting the road is called recessed land. So the part of land which is not on road, main road, which is not abutting the main road is called recessed land. This question can come in 1 mark question. If rate for main road land is V, say rupees 100 or V per square meter, then rate for recessed land to be taken as 75% of V. For example, so if we have taken land rate for this part of the land, so this is L-shaped plot is there. So this is the road. So for this portion of the plot, there is no attached road to it. So if we have taken V as a value of the plot for this part of land, so this part of land will be equal to 75% of the value land rate of considered for this part. So likewise in this case, this is the recessed land, so 75% of value of this land. So please note that after implementation of FSI concept, full utilization of recessed land is possible. Even if keeping it unbuilt, so the side area can be used as garden, swimming pool, etc. to meet FSI norms. So even if I'm not able to construct anything on this piece of land, I can use this area to meet out my FSI norms, and I can use this area for gardening, swimming pool, etc. So this concept is an old concept. So now this method is not very much used. However, for academic purpose, we should know this method. Last method into this series is that landlocked method. So a plot which doesn't have access to government, what is landlocked land? A plot which doesn't have access to government or public road, and legal right of way doesn't exist to approach the plot. Such land is known as landlocked land. So if any piece of land which is not having direct access to the government or public road, and it doesn't have any right of way to the main road, then that land is called landlocked land. Such land is useful to adjoining plot owners or to the investors who foresee possibility of getting access road to the plot in future. So if I am neighbor to that landlocked land, that land I can use, it is useful to me. Or if I have some internal information, I'm a bureaucrat, or I'm a government official, or I'm some politician, I have knowledge that some road is going out of that area, and that road will touch the road, that landlocked land. So then I can have some, I can presume some value out of that plot under development plan. So that is possible. Value of landlocked land may reduce up to 75 to 80% of adjoining land rate. So if my adjoining plot which is abutting the road is having land rate of say 100 rupees, so as per various court ruling, up to 75 to 80% discount I can give on land road on land rate which is landlocked, right? An important case study case example is there. In case of M. Achwath and others, the Honorable Bombay High Court held that value of landlocked land could be assessed at 75% less from value of prevailing rates in the locality. However, facts and circumstances in each case will be different, and actual reduction will depend on them. So we'll discuss different scenarios, and we'll see how this value of landlocked land can vary and can be discounted under various scenarios. So there could be three situations of landlocked land from academic purpose and from practical scenario also. So this is situation number 1, wherein plot A is a landlocked and plot B is adjacent to plot A, and plot B is having road access. So regular MC road is hardly 5 to 10 meters away from the landlocked land plot. So from this plot A, the main road is hardly 5 to 10 meters. So this is situation number 1. We will try to understand these situations with the help of an example in subsequent slides. So situation number 2 could be plot A, we maybe 20 to 30 meter away from the road. So this is plot A. So this is 20 to 30 meter away from the road. So this side road is there, 3 side road is there, and there may be possibility of having right to access road through any of the adjoining plot B, C, D, E. So any of the plots like B, C, D or E, any owner of these plots can allow right of way to plot A to the main road. So this is situation number 2. And situation number 3 is that in case of a landlocked plot is far away from the road, access may be required through multiple owners. Thus access permission is not possible. So here plot number A, if want to access to the main road, need to take permission from B, C, D owners. So 3 owners are involved. So there is very bleak chances that all 3 owners will agree to give right of way to the owner of A, and this land will remain landlocked. It is a high probability. So let us understand all these 3 situations and how these 3 situations affect value of the landlocked land with the help of example for each of the 3 situations. Situation number 1. Owner of plot A desired to sell the plot having area of 800 square meter. Prevalent land rate of plot abutting road in the locality is 1000 rupees per square meter. Owner of plot B want to sell. This is landlocked A. This is landlocked B, land B, and owner of plot B wants to sell his plot to owner of A at 1500 rupees per square meter. Area of plot B, which is this, is 200 square meter. So calculate value of plot A, landlocked plot, rate for plot A, and discount on land rate of plot A vis-a-vis market land rate. So information given in this question is that market rate for the land is 1000 rupees per square meter. However, owner of B want to sell his land to the owner of A at the rate of 1500 square meter. Area of land of plot B is equal to 200 square meter. However, area of plot of A is 800 square meter. So value of plot A, rate per square feet of plot A, and discount we have to calculate. So sale value of plot B, which the owner of B is expecting or asking for, is 200 square meter is the land area of plot B, and 1500 rupees per square meter is owner of plot B is asking from owner A. So total value of plot B is 3 lakh rupees. So if owner of A purchases plot B, then combined value of plot A plus B will be there for owner of plot A, and combined area of plot A and B will be equal to 800 for A and 200 for B, that is 1000 square meter. For total area, and land rate given in the locality is 1000. So total value of the land, combined value of 2 plots for owner A, if he purchases plot B in his own name, then its value will be 10 lakh rupees. So net sale value of the plot A, so net proceed the owner of plot A will get after purchasing plot B is equal to total value of the combined value of the 2 plot is equal to 10 lakh minus value of plot B, which owner of A is required to pay to owner of B. So remaining land amount is 7 lakh rupees. So this is the value of this will be the value of plot A if owner purchases the land of plot B. So that means land rate for plot A will be equal to value of plot A divided by area of A. Plot A. So value of plot A is 7 lakh rupees. Area of plot A is given in the question, which is 800 square meter. So 875 rupees per square meter would be the land rate for plot A if owner of B purchases land of plot B. Discount on land rate. So it is equal to land rate market land rate is 1000 rupees square meter. However, land rate of plot A after purchasing plot B is 875. So 125 divided by 1000, which is land market rate, is equal to 12.5%. So however, as per court case, 75 up to 75% discount is allowed. But in this particular case, since owner of landlocked land A is able to purchase adjoining piece of land B, that is why his discount has reduced from 75% to 12.50%. Example for second scenario is owner of plot A desired to sell his plot at measuring 800 square meter. So this is plot A, and this is plot A, and owner of the area of this plot is 800 square meter. Prevailing land rate abutting the road is rupees 1000 per square meter. So any land which is adjoining the road is 1000 square meter. Owner of plot C has agreed in writing to permit right of way, to give right of way to owner of plot A. So owner of C, this is plot C. So owner of this plot has agreed to give right of way of size 6 meter into 60 meter, 60 meter and 6 meter wide from this main road to plot A by on monthly lease rent of 2000 rupees per month. So calculate value of plot A, rate per square meter of plot A, and discount on land rate of plot A vis-a-vis market. So data given, area of plot A is given, land rate for overall market is given, dimensions of the right of way is given from plot C, lease rent, monthly lease rent is given through plot C, value of plot A, rate for land rate for plot A, and discount rate on land rate of plot vis-a-vis market is to be calculated. So it is given in the question that 1000 rupees per square meter is the land rate for in the locality. However, this plot is a rear plot. It is not abutting the main road. So because of location of this plot, we can assume a 20% discount on the market land rate. Let us assume this plot is having land rate of 800 rupees per square meter after getting right of way. So since land area of plot A is given 800 rupees square meter and 800 rupees per square meter is the land rate. So put together 6.4 lakh is the value of the total land after getting the right of way. But to arrive at the net value of the landlocked land, because this value will be arrived after getting right of way, since owner of plot A has to pay certain annual rent of 24,000 rupees, which is 200 rupees per month, multiply by 12 into 12, so it is 24,000 per month, per year, sorry, perpetually. So thus present value of cost of rent, assuming 8% capitalization rate, is equal to annual rent divided by capitalization rate, it is equal to 3 lakh rupees. So we have to deduct these 3 lakh rupees of annual rent which is required to be paid by owner of A from the total value of plot A, which gives us the net value of landlocked land plot A. So value of plot A minus present value of lease rent is equal to 6.4 lakh minus 3 lakh is equal to 3.4 lakh is the net value of landlocked land after landlocked land if it gets right of way through plot number C. And right of way is given at a monthly lease rent of 2000 rupees per month. So land rate for plot A is equal to 33,40,000 rupees divided by 800 square meter. It is 425 per square meter. So discount on land rate is equal to market land rate minus land rate for plot A divided by market land rate. So discount is 575 divided by 1000, so that is 57.50% will be discount instead of 75% discount as mentioned in the court case. So this is the example for third and last situations in which owner of plot A need to take approval from B, C, D, and there is very bleak chances that he will get right of way from multiple owners of the front land. So for example, owner of plot A desired to sell plot having area 800 square meter. So it is the plot A and area of this plot is 800 square meter and land rate along with main road is 1000 rupees per square meter. So land rate for this front land is 1000 rupees per square meter. There is no possibility of obtaining access through plot BCD. So chances are very less that owner of all these three plots will give right of way to the owner of plot A. So we have to calculate value of plot A and all these things. So in this case, area for this plot is given, market land rate is given, and there is no possibility of right of way. So land value, fair market value of this plot as per court ruling, since there is no possibility of right of way for the landlocked land, 75% discount of fair market value land rate is to be applied, straightforward. So fair value of land is equal to land area into 25% of the market land rate, which is equal to 1000. So 250 rupees per square meter land rate we have to consider. So put together value of the total plot area A is equal to 800 square meter into 250 rupees per square meter is equal to 2 lakh rupees is the value of the plot. So 75% discount we have to consider in this case. Thank you very much for watching this video on fourth session on in market approach to valuation. So this was the second last session. So before I'll tell you what we are going to have in last session, which is fifth session on market approach to valuation, I would request you to please subscribe to this channel and click on bell icon so that you will be immediately notified about next video which I am going to upload. So in fifth and last session of this series on market approach to valuation, we are going to discuss about theory and example and case studies on joint venture, structure of joint venture, real estate joint venture development agreement and methods, and example and case study. There is a high probability 1 or 2 marks theory question would come, and a case study up to 12 marks may come out of this session. So please follow this session, and thank you very much for watching today's session. Thank you.